We all know the Warren Buffett story, right? The Oracle of Omaha, the billions.
No,
It's legendary.
absolutely. A household name.
But when you think about just how long he's been successful, I mean, decades,
Right.
what's really behind that staying power?
Right. It's more than just smart stock picks.
Exactly. We think a less talked about secret is his incredible adaptability. It's not just investing, it's this constant evolution.
Uh-huh. Keeping up with the changing world.
So that's our deep dive today, really digging into the adaptability of Warren Buffett.
Precisely. We've looked at some really interesting material covering his career, and you see this theme popping up again and again. Constant evolution.
It wasn't like a one-shot formula.
No, not at all. It was a continuous learning process, adjusting as he went. So our goal here is to explore maybe 7 key phases or aspects of his journey
Okay.
to really get a handle on how this adaptability fueled his success, And these are lessons that honestly go way beyond Wall Street.
Sounds great. Okay, so let's jump in. Where do we start? The beginning?
Right. Yeah, the foundational adaptation, learning and applying Graham's value principles.
Right. Benjamin Graham.
Yeah.
Buffett famously studied under him. The whole idea of value investing, finding companies selling for less than their worth.
Those cigar butts, as Graham called them.
Yeah, the ones with maybe one good puff left in them. But Buffett's adaptation here wasn't just like understanding the theory.
No, it was how fast and how deeply he absorbed it and then applied it. We're talking a pretty rigorous analytical framework.
You see that early on.
Oh, definitely. Even his early business ventures, selling gum magazines as a kid, that shows an early knack for translating knowledge into action.
Taking the theory and making it real.
Exactly. And he wasn't afraid to start small, build up capital through these different little things. That willingness to learn the ropes, that's adaptability right there.
And you can see how that initial phase, that grounding, really set him up later on, didn't it?
Absolutely. It gave him this solid research-based foundation. It wasn't just guesswork.
And the margin of safety concept from Graham.
Crucial. That became totally ingrained. Managing risk was fundamental from day one. Plus, those early wins, however small, they let him build the capital needed for bigger plays down the road.
So it was adapting the theory into like practical capital building.
You got it.
So if you're listening, maybe running your own business, what's the application here? What's the takeaway from phase 1?
I think the big one is to really master the fundamentals in your field. Find your Graham, whether it's a mentor or deep study.
Do the homework.
Yes. Prioritize that deep analysis before you commit resources. And critically, build that buffer, your business's own margin of safety.
That makes sense. And it contrasts pretty sharply with other approaches at the time.
Oh, yeah. You had plenty of folks focused on short-term trading, trying to time the market. Very different game.
Guessing the swings.
Right. Or people chasing quick riches without any real fundamental analysis. Just speculation, really.
And, of course, just following the crowd, the market hype.
Which often has little to do with actual business value. Buffett learned early to tune that out.
So distilling that down, what's the core lesson from this early adaptation?
Well, first, that a strong analytical foundation is just vital for long-term success, period. Second, discipline, sticking to your principles even when they're not popular. That takes guts, but it pays off.
And the starting small part.
Don't underestimate it.
Yep.
Learning from those early hands-on experiences builds real wisdom. You can't get that just from a book.
Okay, so a solid foundation in Graham's value principles.
Mm-hmm.
But then there's a major evolution, right? This brings us to section 2. Adapting from just price to quality.
Yeah, this is a huge pivot, and Charlie Munger's influence here is undeniable.
Right, his longtime partner.
Exactly. Buffett started with those cheap cigar butts, which often weren't great long-term businesses. Munger helped him see the power in paying a fair price, maybe even a slightly higher price, for truly excellent businesses.
The ones with staying power.
The ones with those economic moats, the durable competitive advantages that protect them. This shift was absolutely essential for Berkshire to scale. You can only find so many decent cigar butts.
So the adaptation was realizing that lasting value came from quality, even if the initial price wasn't rock-bottom cheap.
Precisely. It broadened his definition of value.
What were the signs that he was really internalizing this shift? How could you tell?
Well, the partnership with Munger itself is a big sign. Listening to and integrating that perspective.
Yeah.
Then you see it in his investments, in his writing. The focus moves beyond just the numbers, the quantitative to the qualitative.
Like management quality. Brand strength.
Exactly. The durability of the competitive edge. And, crucially, he showed a willingness to pay up for a business if that long-term quality and the moat were truly exceptional.
And making that shift must have unlocked some significant benefits.
Oh, enormous. It allowed Berkshire to invest in businesses that could actually grow and sustain themselves over decades.
Not just a quick flip.
Right. It shifted the strategy towards buy and hold forever, or at least for a very long time, which meant less trading, fewer decisions, and letting compounding really work its magic in these great companies.
Okay, so translating that for an entrepreneur listening, how do you apply this quality over cheapness idea?
I think the core application is to focus relentlessly on building a business with a real, durable competitive advantage. Your own moat, what makes you hard to copy.
Find your unique edge.
Yes. And seek out partners, advisors, mentors who challenge your thinking constructively, like Munger did for Buffett.
Don't just surround yourself with yes men.
Definitely not. And prioritize the long-term health and quality of your venture, even if it means passing up some quick, easy wins sometimes.
Thinking about the contrast again, who maybe didn't make this leap.
Well, you probably had some strict Graham followers who stuck too rigidly to just the lowest price metrics and maybe missed out on fantastic companies. Then there were investors still chasing fads or companies with no real sustainable advantage, just operating in hyper-competitive spaces.
The companies without moats.
Exactly. A tough place to be long-term.
So key lessons from this major pivot for entrepreneurs.
First, never stop learning and be willing to evolve your core strategy. What worked yesterday might not work tomorrow.
Stay flexible.
Absolutely. Second, recognize the power of partnerships and diverse perspectives. They can sharpen your thinking immensely.
And third,
Build quality. Investing time and resources into building a high-quality business creates a foundation for lasting value that's hard to beat.
okay, investment philosophy evolved. Now let's talk structure. Section 3. The structural innovation adapting capital allocation using insurance float. Sounds like a really distinct part of the Berkshire story.
It really is. This was a masterstroke of financial engineering, frankly. A brilliant adaptation. Buffett saw something others didn't or couldn't execute on.
He was.
He recognized that insurance companies collect premiums up front but pay out claims later. That money, held in the interim, the float.
Could be used.
Exactly. Could be invested. It was essentially a source of very low cost, sometimes even negative cost, capital. By acquiring insurers like GEICO and National Indemnity, he structured Berkshire to harness this float for other investments and acquisitions.
That wasn't standard practice, was it?
Not at all in an investment holding company context. It gave Berkshire this unique, powerful financial engine. Think about having a pool of money you can invest before you potentially have to pay it back. That's the float advantage.
So what were the signs he was adapting the structure this way?
First, just recognizing the capital generating potential within the insurance model itself. That required insight.
Seeing the opportunity.
Right. Then, the deliberate design of Berkshire Hathaway to channel that float effectively into his investment arm. And finally, the successful integration making insurance a core, profitable part of the whole operation. That proved the adaptation worked.
And the benefits of this float must have been huge.
Transformative. It gave him a consistent, reliable, and cheap source of funds for
And
deals.
fuel for growth.
Big time. It allowed for much larger investments over the years than he could have managed otherwise. It created this self-reinforcing cycle. Successful investments generated more capital, which funded more investments.
So for entrepreneurs today, maybe not running insurance firms, how can they apply this kind of thinking?
It's about looking for creative financing beyond just bank loans or venture capital. Analyze your own business model. Are there hidden sources of capital? Ways to leverage assets or cash flow differently?
Thinking outside the standard funding box.
Exactly. And consider your company structure. Is it set up to allocate capital efficiently to the best opportunities? That's a key lesson here.
What were the alternatives, the contrasting approaches back then?
Most companies just relied on banks or the public markets for capital, standard stuff.
Yeah.
Many investors either didn't understand the float mechanism or couldn't access it, and traditional thinking kept operations and investment deployment very separate. Buffett blurred those lines brilliantly.
Okay, big takeaways on this structural innovation for entrepreneurs.
1, innovation isn't just about products. It can be in your business model, your financial structure.
Yeah.
2, really understanding the mechanics of different industries can reveal unexpected strategic advantages, like Buffett did with insurance.
And 3,
Efficient capital allocation is absolutely fundamental, getting the right money to the right place at the right time. That's how you compound success.
okay, let's shift again. This one gets a lot of attention.
Sure.
Section 4, Intellectual flexibility adapting to new industries, including tech. Buffett famously avoided tech for ages.
He did. For a long time, his mantra was invest in what you understand.
Yeah.
And he felt tech was outside his circle of competence, as he calls it.
But then, Apple, Amazon.
Exactly. Huge investments. That represents a significant adaptation. And it wasn't like he just flipped the switch. It seems to have been a gradual process.
Driven by learning.
Driven by continuous learning, yes.
Wow.
And recognizing that his core principles, strong brands, customer loyalty, dominant market positions, moats, actually did apply to some of these tech giants, even if the technology itself was complex.
And he's been pretty open about maybe waiting too long on some of them, right?
He has that humility, that willingness to admit maybe he missed something earlier. That's a key part of this intellectual flexibility. It ties into his famous reading habit, too.
Reads constantly, they say.
Voraciously, that's how he keeps expanding that circle of competence, understanding new industries, new dynamics.
So what were the clear signs this adaptation was happening?
Well, the investments themselves, obviously, making massive bets in sectors he'd previously shunned.
Actions speak louder than words.
Definitely. But also his own commentary, acknowledging the shift, explaining his reasoning, and just that visible, lifelong commitment to learning, that underpins everything.
What were the benefits for Berkshire of him finally embracing tech to some extent?
It opened up access to enormous growth opportunities, frankly, some of the biggest wealth creators of the last couple of decades.
Staying relevant.
Exactly. Keeping Berkshire relevant and effective in a business landscape that was changing fast, and arguably continuing to learn and adapt, improved the quality of all his decision-making.
So for entrepreneurs, how do you cultivate that kind of flexibility?
You have to make learning a habit. Real, intentional, continuous learning. Stay curious.
Read widely. Talk to people.
All of the above. Be open to ideas that challenge your current views. And this is hard, but be willing to admit mistakes and pivot.
Check the ego.
Check the ego. Actively work to expand what you understand, your own circle of competence.
And the contrast here. Who doesn't do this?
You see investors who stay incredibly rigid, maybe clinging to old models, and they miss huge shifts.
Yeah.
You see leaders who are too proud to admit they were wrong or to change course, even when the writing's on the wall.
And businesses that just stop learning.
And become obsolete. It happens all the time.
So the key lessons from Buffett's tech adaptation.
Humility is huge. Self-awareness allows you to recognize when you need to change. Second, never ever stop learning. It's the fuel.
And third,
adaptability isn't optional. In today's world, it's a requirement for navigating change and uncertainty.
let's move to something maybe less tangible, but just as important. Section 5. Emotional resilience, adapting to market volatility. Markets go crazy sometimes.
They certainly do. Downturns, crashes, panics, they're inevitable. And the natural human reaction is often fear, maybe panic selling.
Yeah, wanting to get out.
Buffett's real superpower here, arguably, is his emotional stability. His ability to stay calm, rational, disciplined when everyone else is freaking out.
He sees downturns differently.
Completely differently.
Right.
He famously says he likes it when prices go down because it means he can buy more of the great businesses he loves cheaper. It's an opportunity, not a disaster. That reframing is a powerful adaptation.
And sticking to that has paid off incredibly well.
Massively. It helps him avoid those devastating, emotionally driven mistakes like selling at the bottom.
Right.
Instead, he uses the panic of others to his advantage, buying quality assets when they're on sale. It just reinforces the power of patience and thinking long term.
The old saying about wealth transferring from the impatient to the patient.
He's the poster child for that. His temperament is perfectly adapted to the market's craziness.
So for an entrepreneur facing their own storms, tough markets, business setbacks, what's the application?
It's cultivating that same emotional discipline, building resilience. Don't let fear drive your decision.
Easier said than done sometimes.
Oh, absolutely. But having a clear long-term strategy helps. A North Star to guide you through the turbulence so you're not just reacting.
And trying to see opportunity in the chaos.
Yeah, try to reframe. Is this setback actually creating an opening? A chance to gain market share, to innovate? It takes practice, but it's powerful.
And the contrasting behaviors we usually see.
Well, the market timers, always trying to guess the next move, often getting burned.
Mm-hmm.
Investors driven purely by fear or greed, making irrational choices. And companies that make knee-jerk reactions to market noise, often damaging their long-term prospects.
So the crucial lessons on emotional resilience for entrepreneurs.
Temperament is just as important as intellect, maybe more so over the long haul.
Interesting.
Patience isn't passive. It's an active discipline. It takes effort, but the rewards are huge.
And the third.
Keep perspective. During a crisis, stepping back and seeing the bigger picture can reveal strategic advantages others miss in the panic.
Okay, great point. Let's broaden out even more. Section 6. The human element, adapting communication and prioritizing integrity. This isn't just about numbers anymore.
Not at all. And Buffett's adaptability here is really interesting, too. It extends to his leadership, how he interacts with people.
His communication style is pretty famous.
It is. It's evolved to be incredibly simple, clear, transparent, honest. He writes his annual letters himself, famously, in plain English.
And admits mistakes very openly.
Which is huge for building trust. And apparently, he wasn't always a natural public speaker. He actively worked on that, took courses. That's personal adaptation.
Overcoming a fear.
Right. And underpinning all of it is this unwavering commitment to integrity. His reputation is paramount, and he adapts his actions to always protect that trust.
And the result seems to be incredible loyalty.
Unparalleled trust. From shareholders, employees, the public. Berkshire's reputation, which he says is priceless, is a direct result of this consistent approach.
And it creates a certain culture within Berkshire, too.
Definitely. A culture of accountability, of learning from mistakes, because the leader models it.
So how can entrepreneurs apply this?
Yeah.
The communication and integrity piece.
Well, actively work on your communication skills. It's a learnable skill. Be clear, be concise.
And be honest.
Be transparent, even with bad news. Especially with bad news. Build relationships based on trust. And make integrity non-negotiable. It has to be the bedrock.
What are the contrasting styles you often see out there?
Oh, leaders who hide behind jargon obscure the truth. Companies that lack transparency try to spin everything.
Yeah, we've all seen that.
And sadly, business cultures where corners are cut, where integrity takes a backseat to profits, that rarely ends well long term.
So key takeaways on this human element for entrepreneurs.
Effective communication is a skill worth investing in. Practice makes perfect.
Mm.
Trust isn't given, it's earned through consistent honesty and transparency, day in, day out.
And finally,
prioritizing integrity isn't just morally right, it's essential for long-term credibility and success. Your reputation is everything.
okay, one last section, section 7. The legacy mindset, adapting to the future and societal impact. This feels like a shift in focus again.
It does. It speaks to his incredibly long-term perspective. He's adapting his thinking beyond just Berkshire's next decade, looking at his overall impact and the distant future.
The giving pledge comes to mind.
A huge part of it. Committing the vast majority of his wealth to philanthropy shows a focus far beyond personal accumulation.
And he's thinking about future challenges too, like AI.
Yes, he's engaged with those big questions, thinking about their societal implications. And critically, he's adapted by planning for the future of Berkshire after him.
The succession plan with Greg Abel.
Exactly. Proactively managing that transition. It's an adaptation focused on ensuring the company's endurance and his legacy. It's a shift from just building wealth to shaping its future impact.
And these actions, they really show that long-term view in practice.
They do. The philanthropy is obvious. Thinking about AI's impact shows foresight. And executing a smooth succession plan is vital for the long-term health of any great organization.
What are the benefits of adopting this kind of legacy mindset?
Well, for Buffett, it ensures his wealth has a massive positive impact. For Berkshire, it positions it for continuity and continued success. And it just demonstrates ethical leadership and foresight.
How can entrepreneurs, maybe running much smaller ventures, incorporate this?
Develop your own long-term vision. Where do you want your business to be in 20, 30 years? What impact do you want it to have?
Thinking beyond the next year's targets.
Way beyond. Consider your company's role in society. How can you contribute positively? And even if it feels early, think about future leadership, about continuity. Planning for succession is responsible leadership at any scale.
And the contrast. What happens without this mindset?
You see leaders totally fixated on the next quarter's results, companies that ignore their wider impact on society or the environment.
And founders who don't plan for what happens next.
Right. And the business they built often falters or disappears after they leave. A lack of legacy planning.
So final lessons on this legacy-focused adaptability.
A truly long-term mindset is crucial if you want to build something that lasts.
Mm-hmm.
Integrating ethics and giving back isn't separate from success. It can be a core part of a meaningful legacy.
And a third one.
Planning for the future, including who comes after you, is a fundamental act of leadership. It ensures your vision can endure.
Wow. Okay, so wrapping this up, it really feels like the story isn't just about Buffett the investor.
No, not at all. While the returns are incredible, this constant thread of adaptability learning, pivoting on strategy, innovating structurally, staying flexible intellectually and emotionally, communicating with integrity, planning for the long future, that seems to be the real bedrock.
And these lessons, they really resonate beyond just investing, don't they?
Absolutely. For any entrepreneur, anyone trying to build something of value in a world that's always changing, these principles of adaptation are incredibly powerful.
A fascinating journey through his career, looking at it through that lens.
It really is.
And maybe something for you, our listener, to chew on.
Yeah.
What are the specific mental models or decision-making techniques that enable this level of adaptability in someone like Buffett? How does he maintain that rationality, that independent thought? That might be worth exploring further on your own. We all know the Warren Buffett story, right? The Oracle of Omaha, the billions.
No.
It's legendary.
Absolutely. A household name.
But when you think about just how long he's been successful, I mean, decades,
Right.
what's really behind that staying power?
Right. It's more than just smart stock picks.
Exactly. We think a less talked about secret is his incredible adaptability. It's not just investing, it's this constant evolution.
Uh-huh. Keeping up with the changing world.
So that's our deep dive today, really digging into the adaptability of Warren Buffett.
Precisely. We've looked at some really interesting material covering his career, and you see this theme popping up again and again. Constant evolution.
It wasn't like a one-shot formula.
No, not at all. It was a continuous learning process, adjusting as he went. So our goal here is to explore maybe 7 key